Well, good morning and welcome to Experian's Fraud Panel, Unified Fraud Strategies, Creating a Circle of Trust with Businesses and Consumers. My name is Gary Stockton. I work in Business Information Services here in Experian, and I'll be moderating today's discussion. Please make use of the questions applet in the GoToWebinar tool panel. We'll be using that later on. We'll also be asking you to participate in a poll later on, and also monitoring the question box throughout. You can also find a copy of the slides for today's discussion in the handouts area. Leading our discussion today are three experts working in the different areas of Experian. David Britton is VP of Strategy for Global ID and Fraud. He brings a wealth of experience to his current position, offering unique insights into the criminal methodology behind cyber fraud, as well as an understanding of the evolving digital identity landscape. As an early internet fraud investigator, he played a central role in the developing cutting-edge fraud prevention technologies in the digital space. Javier Rodriguez-Paiva is a strategic analytic consultant on Experian's commercial data sciences team. In his current role, Javier helps clients deploy analytic-driven strategies to combat commercial fraud. He has 10 years experience working in the financial services industry with a focus on risk, portfolio marketing and analytics for small business portfolios. And Ryan Spalter is a commercial fraud consultant here in Business Information Services. In his role, Ryan brings market insights related to commercial fraud to clients and works with them to understand their needs and identify solutions to address those needs. He has worked in the financial services industry for 14 years, filling roles in product management and in the know your customer space. In recent years, he has moved into providing financial crime solutions to institutions across various industries. So, David, to kick things off, you had recently released a report on fraud. Could you provide some insights on the Global Identity and Fraud report for 2021?
Yeah, thanks, Gary. Happy to do so, and it's a pleasure to be here on the panel today and to field some questions and to talk through some topics that are hopefully of interest to the audience. Yes, as you mentioned, Gary, within Experian's Global ID and Fraud Group, we've done some fairly extensive research over the last several years, which manifest in what we call our Global Fraud Report, Identity and Fraud Report. This year was a little bit different with the pandemic, as you can well imagine. We decided that it was important to start to get some snapshot views throughout the course of the pandemic to get a sense of both consumer attitudes as well as business attitudes related to challenges with identity, challenges with fraud, and so on. This year's report, we surveyed about 9,000 consumers and 2,700 businesses across the globe. And we did the field work across three different waves, as I mentioned, from June 2020, September 2020, and then again in January of this year, to try to see if there were any emerging trends that came out as a result of that. We surveyed these different folks across 10 different countries around the world. And each of the businesses that we surveyed had a certain criteria that had to be met in terms of size of business, in terms of revenue. And on the consumer side, these had to be digitally active consumers that we were engaging with in the survey results. So with that, if you don't mind giving me a click, we'll jump right into some of the findings, and then we'll summarize some of this as well. One of the interesting things, and it's clearly not a surprise to anyone, is that there was a tremendous growth in digital last year as a result of the pandemic, fully 20% growth on the increase in traffic. By some analysts' estimations, this sort of accelerated the amount of digital traffic for multiple years. So in other words, we advanced the digital agenda, if you will, in both commerce and in digital by several years based on what we saw happening during the pandemic and the need to engage digitally. We also saw, as part of the consumer survey, that despite some of the financial challenges that many consumers experienced, there was still this desire and this expectation that over the next 12 months, there would be an increase in both banking and shopping transactions across the consumer base. That's a healthy indicator of where the market is going and showed that the digital channels were actually working and that there was trust by the consumers in those digital channels to be able to engage with businesses. And then ultimately, and finally, on one of the interesting tidbits that came out was we asked specifically about how people were paying in their digital or non-digital interactions. And we saw that there was a significant uptick, 7 percentage point uptick in the use of mobile wallets I think there's a couple of things to that. First of all, there's been a lot of touted security promise in a mobile digital wallet in terms of making a payment. The encrypted card data, the encrypted payment data, the fact that in many cases the data stays on the device itself and isn't transmitted back and forth was always very positive from a security perspective on the digital security side. But then separately, during the pandemic, there was a desire for consumers to not have to give over a plastic card at the point of payment necessarily. And so there was a basic hygienic element that said if you could just pull out your own phone and use that as a digital wallet at a point of sale, it could be considered a positive benefit as well. When we looked at the consumer attitudes related to fraud and security specifically, a couple of things came to mind. First of all, unchanged over the last 5 years is the idea that consumers really do prioritize security in digital engagements at the top of the pile. Above other things like convenience, above other things like preference, security remains the top slot when it comes to security, when it comes to their goals for digital engagement and priorities there. Interestingly, identity theft had a bit of an increase. So concerns around a consumer and identity related issues, both in terms of identity theft and then, as you'll see, privacy in a moment. But identity theft, we saw a slight rise in the concern there. There was a lot of breach and data compromise activity that had happened leading up to the pandemic. And so there was sort of a renewed concern from the consumers about the security of their data from an identity theft perspective. And then if you look at the bottom line here, in terms of privacy, again, there was an uptick where we see an increase in concerns around privacy from the consumer market that was stronger than it had been prior to the pandemic. In some regions, we believe that this was born out of the idea that certain governments and certain agencies were asking consumers to allow them to track their location and track other things as they were trying to do the pandemic management. And so we believe that there were some privacy considerations and concerns that came out as a result of the pandemic itself, leading to a slight increase on the privacy side as well. This led to an interesting set of observations around how do consumers want to be, what methods do they want to use when they're engaging in a digital channel? And what we saw is that for a consistent number of years now, we've seen that physical biometrics has continued to rise. So consumers are actually very eager to use the physical biometric capabilities. The advent of things like Touch ID and Face ID have led to the use of these technologies, and that remains one of the most preferred methods of authenticating, if you will. Second is the PIN code. This is the one-time passcodes may be sent to a device. The market has done a tremendous amount of pushing this out into to the market. A lot of businesses use one-time passcodes now, and consumers are comfortable with them, and so that's a preferred method as well. This third one was a really interesting pivot point this year. So for the first time in the years that we've been doing this survey, we saw that consumers displaced the use of passwords for the first time and instead prioritize behavioral analytics or a passive means to being authenticated in a digital channel. So where they in the past would have said that passwords were one of their predominant, most preferred methods of authenticating, we're now starting to see that consumers are giving businesses the permission to do a little bit less intrusive work when it comes to authenticating them. And the rise of behavioral analytics, where how a user interacts with their device, what their typing speed is, how they click on buttons, how they move their mouse, some of those passive attributes become much more acceptable now among the general population in terms of authenticating the consumer. Very interesting this year and this time around. When it comes to recognizing or identifying customers, new strategies are really coming to the rise. First of all, businesses are constantly improving the customer experience and the journey, with 9 out of 10 businesses now claiming that they have an explicit digital customer journey strategy. 47% of the businesses we surveyed actually implemented those programs on customer journey during the pandemic. And then separately on the identity piece, 82% of businesses now claim to have a customer recognition, customer identification strategy in place so that they can recognize their return customers as they come back. Now, there is a bit of a cautionary tale. If you go to the next slide, what we've seen in the past from our survey in the years past, from our past global fraud report, there was already a sense of confidence that the businesses had. 95% of businesses were confident that they could recognize their customers accurately. or to identify them accurately. If, however, in that same survey, you look at the results of how consumers felt in how well they were recognized or identified by a business, you can see a pretty big disparity. Only 55% of consumers didn't feel recognized by the businesses that they were being serviced by, where the businesses, 95% of them felt they were doing a great job at identifying customers. So this gap between what we're calling the great recognition divide is something that's important for businesses to understand and to say, despite the systems you may have put in place, despite some of those tools that are in place, it's important to ensure that you really are actually recognizing the consumers to their satisfaction as you start to roll out these strategies going forward. Here's the other part of it, is that typically what we found is businesses believe that if they can solve the identity crisis, so they can solve who the person is that's coming to their business from a consumer perspective, or even from a partnership or a small business perspective, if they can recognize the entity that's coming to them, the natural consequence, if done accurately, is to be able to remove fraud from the problem. Because fraud only happens really when there's an anonymous environment, or when there's an anonymous person coming in and interacting that you simply don't know who they are, how they respond or react or interact. So what we've seen, though, is despite all that work on identity and despite the work on trying to solve the identity problem, we are still seeing that 2 out of 3 businesses are have increasing concerns about the overall level of fraud against the business. So that means that the work is not done yet, and there's more to be done when it comes to fraud mitigation itself. As we said, from the consumer side, security is really a very critical part, very important to the consumers. If you look at the breakdown of that 55%, you look at it across the different demographics, you see that those above the age of 40 are actually a little less concerned about fraud than the ones that are younger than 40. Even though they are actually more concerned now than they were before the pandemic, there is this little bit of a shift or a change at the demographic level on the age side. We believe that in some part this may be due to the fact that that those younger than 40 may not have quite the earning potential yet, may not have quite the assets to protect. And so there's a greater chance of loss for what they may have. And so there's a higher concern there. There's the other side that says on the biometric usage, consumers over the age of 40 actually 37% feel safer using biometric. Clearly, though, the adoption rate at the under 40s is much higher when it comes to the comfort around using biometric data for authenticating and securing their interactions. So as we looked at all of the data that came back, and we started to look at how businesses were prioritizing their efforts for the time going forward, for the year ahead, we did find that we were actually quite encouraged by the fact that companies are planning to still increase their investment in fraud prevention, even though they've done a tremendous amount already. As they look forward, the numbers are still the same. Pre-pandemic to post-pandemic, businesses are continuing to invest or planning to invest in fraud detection. We see this with the growth in digital, that there's an adoption of advanced analytics and AI to be able to handle in an automated way the customer influx that's come in through the pandemic. The need for the fraud detection software and methods has been on the rise. This was an interesting one on staffing. We found that the businesses are also planning to have increased staffing to support the digital operations. And then if you skip to the bottom line here, they're also planning to increase their call center staff for the overflow that may happen when people are this new population that may be coming onto digital, when they have challenges with password resets, trying to get to the right answers. The businesses that we surveyed are staffing not just the digital infrastructure support with staff, but they're also on the call center and even in branch staff support for any overflow that may happen. All of which we felt was actually a positive indicator for businesses setting themselves up for the growth that is to come coming out of the pandemic as well. With that, Gary, I'll pass it over to you.
Yeah, excellent background. So what is the connection between customer recognition, fraud prevention, and customer experience work for firms that serve consumers and businesses?
So Gary, I can go first, and I'll be more than happy to provide my perspective. I would like to emphasize 3 major trends that, when combined, really drive a pressing need for AI and advanced analytics for fraud detection. The first one would be that fraud is dramatically increasing both for consumers and businesses. Second one is that the economy is rebounding. And the third one is that COVID has reshaped the environment in a way that it is harder to tell good customers from bad actors. So let me elaborate on this three major trends that I just enumerated. So the first one will be that fraudsters are really continuing to expand their operations, and they're really going beyond the typical consumer identity theft and going into different forms of fraud. First-party fraud is actually a form of fraud that's particularly damaging for businesses. And it's really when bad actors apply for credit without the intention to repay the lender or the supplier. And it's particularly complicated to manage both for administrative and for operational reasons. Now, we are seeing that as fraudsters are ramping up their operations in this way, such as a first-party fraud, we're also seeing that the commercial fraud activity has really, surged since the pandemic started. There are reasons for this. There are programs such as the Payment Protection Program and other stimulus benefit programs that, even though they provided an urgently needed lifeline for businesses in dire straits, they also open a large window for bad actors due to insufficient controls and the haste of getting those funds disbursed. Anecdotally, we know that data published by a very large fintech lender show that over 75 of their PPP loans were underwritten without manual reviews. We also have other very telling data points. According to the FTC Sentinel report, we know that identity theft reports have gone up 188% since the beginning of the pandemic, and fraud reports have gone up by 47%. We also know, and I actually find this next figure a little staggering, there's been a 20,000% increase. Just 20,000%. It's even hard to get one set around that number. Increase in SBA hotline complaints related to potential PPP fraud. So that will be the first trend, increase in fraud. But we also there's a second trend worth acknowledging, is that the economy is rebounding. Business credit is expected to grow as business sentiment goes up. The economy and business activity are really starting to pick up post-pandemic. This is going to result in increased demand for business credit, which in turn is going to fuel increased supply of business credit. Anecdotally, we know that banks, which initially halted all their credit card offers at the beginning of the pandemic, have sent out an estimated 250 or 260 million credit card offers just in March, in anticipation of a rising consumer spending. Now, the third trend that I want to cover is that it is becoming harder and harder to distinguish good customers from bad actors as COVID has really reshaped the market. What do I mean by this? COVID has brought in some new dynamics, particularly in commercial lending, and particularly due to the Payment Protection Program. So we're seeing, on one hand, a lot of businesses closing. They actually leave behind their credit footprints and their credit reports ripe for exploitation from bad actors. On the other hand, we have a lot of small businesses and sole props applying for business credit for the first time in order to apply for their needed benefits. There is very little or no history whatsoever from these businesses to evaluate them from. So we have all this noisy environment, and also, well, in this noisy environment, it's getting also harder and harder to differentiate between credit and fraud losses. Operationally, it's difficult to tag them, and it really requires labor-intensive and manual investigations. So ultimately, there's a lot of noise in this new environment. Now, let's take a step back. We have these three factors, and if we combine them, they're actually making for a perfect storm in terms of commercial fraud. To recap, one, fraudsters have developed a taste and an appetite for commercial fraud. In many cases, they have already penetrated the perimeter of lenders due to PPP lending. We also know that lenders are willing to expand business credit, and we also know that it's harder and harder to tell who's a good customer from a bad actor. So now is when investing in fraud prevention, advanced analytics, AI, in digital decision and software is more needed than ever in order to address these evolving threats, and can really make the difference between capitalizing in this rebounding economy or experiencing serious losses.
Wow. Well, that's incredible. David, any thoughts to response to what Javier just shared with us?
Yeah, there's, as Javier mentioned, there's a tremendous increase in the new fraud that's occurring in the space and the challenges that exist with business. I think there's always this challenge which remains, which is you have to identify the the good customers. You also have to identify the bad actors that are coming through, and the ability to serve the legitimate customers in a more frictionless way is at the top of mind, right? The idea of the customer journey has changed a little bit. It used to be that you had a general idea of a consumer life cycle across various touch points with that consumer in the business. What we're finding now is that businesses that can prioritize what we could call the micro journey, meaning that at every moment, even during a single digital session, there's an opportunity for a business to have insights about what the consumer is trying to do, who the consumer is, and then either reduce the friction for them and make it an easier process, or dynamically step up the challenge so that they can actually detect the fraudsters that are maybe coming through the door. This new evolution into what we might call the micro journey approach across a session for a consumer is really critical in managing that frictionless approach for the good customers while also dynamically assessing risk for the fraudsters.
Ryan, any thoughts?
Yeah, actually, David mentioned a lot about reducing friction, and he's absolutely right when you're thinking about the customer journey. But oftentimes, the market immediately thinks of as the end customer the consumer as the end customer. When in fact, when you kind of look at the supply chain, you have small businesses playing an integral part in that chain. And the point I make here is that, small businesses are customers too. So just as an end consumer, or an individual takes out a loan or purchases a car, small businesses also seek loans and funding from lending institutions. And they, of course, also procure goods and services from manufacturers or wholesale distributors. So just as businesses protect their consumers from fraudsters and themselves, of course, commercial lending institutions and commercial trade institutions need to protect themselves from small businesses looking to perpetrate fraud on them. And, as David and Javier have kind of explained, protection is more important now than ever because fraud rates are at an all-time high across all industries. For lending institutions in particular, a recent IT study on small and medium-sized business fraud found that nearly 20% of their respondents stated fraud was connected to more than 1% of their small business loan portfolio. And, depending on the size of that portfolio, that 1% can be quite a significant loss. Nonetheless, all industries have acknowledged commercial fraud being on the rise, and they want to do something about it. However, through our conversations and various studies out there, who is responsible and who should own the solution is often unclear. If one were to look at job postings these days, they'll find a range of job titles having responsibility for fraud mitigation, but it's often only a piece of what's needed in a comprehensive solution. You won't often find a single description of someone having responsibility for putting in place a comprehensive fraud program. Within the FI and lending world, it's better defined. You can get to that area a little bit easier, but even then, ownership of small business fraud risk can often get blurry. We've actually spoken to customers where does it fall into the commercial fraud risk line of business or the consumer side? So again, you're facing that issue of who owns it. When you move into the trade vertical, you might have procurement might have some responsibility. For fraud associated to partnerships. Or an institution might have a head of risk, but they tend to rely on a variety of partners within the organization to address fraud. Even AR departments, end up with a hand on holding the bag of preventing fraud and part of those losses. So what happens is that amongst many other challenges, because no one properly owns the responsibility of putting in a comprehensive fraud program, looking across all stages of the customer life cycle, or even maybe the micro life cycle that David talked about. That critical prerequisite of putting together a business case for procuring funding often, becomes a hot potato, and no one really wants to pick it up.
Well, audience, we'd like to hear from you. We're going to launch a poll here, and what we want to ask you is, what are the biggest challenges to pulling a comprehensive fraud strategy together for your firm? You should see a poll in place. Go ahead and select which option resonates with you the most.
Yeah, and perhaps
So,
as the poll is going on, I was just going to jump in. I think the idea of how businesses can effectively pull these strategies together is going to be the challenge, right? How do you work across those department lines? And I'm really curious to see what the results will be of this audience, to see how folks are thinking about that themselves. And then clearly we've got a view as well, but interested to see.
about 42, 43% here. We've got a few late voters here. Right tools don't exist for our unique business case or unique business. That's actually emerging here. I'm gonna close the poll here and we'll take a look. Okay. Right tools don't exist for our unique situation. Thoughts, guys?
Yeah, I'll perhaps jump in. I think that this is it's a common theme, right? When you look at the breadth of the requirements, it's difficult to find tools that are the right tools for the situation. And oftentimes we find that businesses are required to assemble a variety of tools and maybe even use tools that weren't intended for the purpose to be able to get the job done. This is an area, we'll just put it out there, that we're eager to engage with our clients to understand some of those pieces. And there's a broad variety of services, tools, and things that can be brought together in meaningful ways. And those are interesting conversations to have.
Okay. So a question for the group. So what can firms do to align to a unified fraud strategy that optimizes the customer experience?
I'll jump in. I think that there's a couple of things. One is, as you look across the different departments within a business, is there line of sight? Is there a visibility to the challenge? First of all, the need for it is the following. We have found that fraudsters love gaps in organizations. Like, they love to go to that point between which two departments may operate, and they'll go and penetrate that part of the business, and they'll find those loopholes. I always say the only people that really read the fine print of your business and your T's and C's are going to be the fraudsters. They tend to know more about your business than you imagine, and that's an area to start to focus on. And so wherever those connection points are between the departments, I think is an opportunity to remedy all types of fraud, right? Having an understanding of what marketing is doing, having an understanding of what procurement is responsible for and where compliance comes in, an ability to sit down with the leaders of those departments on a regular basis to develop a strategy is always critical. And to do so then in a way that doesn't upset the customer experience is also a part of the goal. And I think there are ways to line up the organization broadly to be able to say, what are the objectives, the KPIs, and so on that can be used to manage that risk across the board.
Ryan?
Yeah, and part and parcel to bringing everyone together to kind of talk about it holistically, addressing the fraud program. That's kind of the people side of it. On the more the data and technological side, you need to allow the data to kind of support that approach as well. You need the ability to bring data from each stage of the customer life cycle together, so that you have visibility of who your customer is and what they're doing, so that you can identify those anomalies and spot the fraudster that's taken over your customer's account, or has created a zombie profile for a business that is no longer in existence. These are important aspects to mitigating fraud and putting in a program. But again, as much thought's given on the customer experience, you have to have the data kind of support both sides here. You know, businesses like to roll out products and services. They need to do so with fraud in mind. They can't focus solely on that customer experience. They need to avoid creating silos though when they're doing that. But again, they need to break down silos as well as they're reevaluating their programs. Because once a fraudster's, typically a fraudster's gonna wanna, you know, execute their scheme quickly. You know, there's bust out schemes that they'll execute, but there's also the ones that will play the longer scheme. And once they've infiltrated the organization, it's much harder to detect. Which is why, again, you need data to come together and benefit one area as it does the next area. So from onboarding all the way through detection, through even the end of life, there's an aspect there in those cases where a business is no longer in existence and it's coming back to perpetrate fraud, you know, under the use of a fraudster. But at the end of the day, the need when it comes to consumers and businesses, having visibility into that intersection of small businesses being made up of individuals, that is also critical. So it's not about not just about the life cycle, but it's also about having the ability to see which small business is tied to which consumer or personal guarantor, so that again you have that, you know, greatest ability to know fraud is coming your way.
On the commercial side, what about the importance of blended data? Because you say, you know, businesses are consumers too. What role does blended data play in this equation?
I can jump in here. I think it plays a critical role in building a unified fraud strategy. And that actually echoes one of the top answers in the poll we just ran. So as we're talking about customer recognition and really the ability to distinguish good and bad actors being key in order to grow the business, businesses need tools in order to maximize their ability to do this. And one way that we have found to be very effective is, as you well mentioned, the usage of blended data. This means integrating both consumer and business data in order to develop a holistic view of both risk and opportunity for a prospect. And taking that route really addresses problems of fragmented credit history and really enables creditors to see the entire picture. We have cases, businesses have cases in which especially small business customers often leverage personal credit from the owner or from the principal in order to secure resources, particularly early in their life cycle. Then the other way around, they're actually bad actors that serially register and use multiple businesses in order to abuse creditors. Since the businesses are open and open and closed serially, there's really no traceable business credit history that businesses can rely on. However, some of this activity can be effectively tracked via consumer credit. So really understanding the linkage between consumer and business credit can lead to big gains in two distinct ways. Once, better identification of bad actors means fraud reduction, and also improve customer experience and reduce friction on legitimate customers.
Gary, if you don't mind, I've got maybe one other thought on this, and that's around the sort of the circle of trust that we alluded to earlier on, and Javier just touched on it as well, around customer experience, customer friction. What we found is that there's an interesting trade-off when it comes to businesses that are trusted and their clients or their customers' ability to or desire to work with them. So, for example, businesses that are highly trusted, customers actually have said, we're willing to give the business more data about ourselves and our business if it means a more elegant relationship and an easier process to get things done over time. What that means then is that the business has more data from which to generate insights and to create a better experience for the customer. As they go through that, that means that the next time that customer comes back, there's less friction in the process to get them back in to be able to buy something, do something online, fulfill the service, what have you. So that creates this sort of virtuous cycle of trust, if you will, where the more trusted the business, the more data they're going to get from customers because customers are willing to give it to them. The customer experience is better, therefore the trust of the business goes up. However, this is also easily undone. And what it can do is, for a business that starts to slip a little bit and doesn't have that customer trust, customers become a little more reluctant to give them data, which means that the work around authenticating them, identifying them, servicing them becomes more challenging because they don't have the same insights about that customer because the customer is withholding it. So you get this potential vicious cycle of a lack of trust that can be undone quite quickly if a business isn't clear about how they're using the data, around how they're managing privacy controls and so on. So this is an interesting dynamic that we found through the studies over the years that I think is important for businesses to bear in mind. Consumers are willing to work with you and clients and partners are willing to work with you if there's a transparency in the process and a lack of friction leading to greater trust. And then the inverse is also possibly true.
Excellent. Well, I'm going to open it up for questions right now. We've been monitoring the questions box. There are a few that came in this session. The first one, what practical advice can you share to help a business ensure alignment across departments to solve the fraud problem?
Yeah, I'll take a first stab at this one. This is one we've talked about a lot, but I think there's a couple of things. First of all, aligned strategic objectives. Understanding what your partners in another department may be working on. What are their big objectives for the year? It's a bit of a surprise to us sometimes that when we as a vendor come into a client engagement, we're actually introducing parties to each other within the same business. And the bigger the organization, clearly, the more often that may be. But I think that having an alignment around the objectives, or even a conversation to make awareness around what are you trying to achieve in your department versus what we're trying to achieve, and is there alignment there? And then tactically, it looks like sharing KPIs, sharing those objectives and goals and the measurable goals to say, look, maybe even get creative and say those responsible for fraud have an obligation on KPIs around getting X number of good customers through the door. And conversely, on the marketing side, rather than just putting KPIs around volume increase, making sure that there's a sense of the right customers coming in and the good, strong relationships that can be built rather than just the volume of relationships. So I think there's a number of tools that can be used from a business management perspective across these different KPIs and across departments that can be helpful over time to getting to that seamless approach.
There was a question that came in from Jennifer when you were talking about recognizing an ID validation check. Can you provide some definition around that?
Not sure who that might be for, but happy to take a stab at it. And then Ryan or Javier, unless you guys want to lead.
Well, I'd say in the case of application fraud, there's typically three types we have that you're looking at. Those that involved a fabricated ID. So your synthetic IDs, where they might take, a portion. A fraudster might build a profile where they build that profile with real data, but all that data together isn't a real profile. So, for instance, they may have, one individual's social security number, another's phone number, another's address. You verify any one of those pieces of data on its own, it's going to check out. A little bit less egregious is taking, and a little bit harder to detect is taking, just completely taking someone's identity and using it to perpetrate fraud. The fraud is taking someone's identity, opening up accounts in that name. That profile is going to check out because all that data is ticks and ties together. Now, the third type of those are related to identity. A third type, and Javier touched on this a little bit more when it comes to application fraud, is that first-party fraud, where you have an individual that is, quite frankly, bold enough to commit fraud in their own name. They're using their own identity to open up that account, order those services, procure those services, order those goods, but they have no intent of paying. So when we look at application fraud, identity is a big piece of it, but it's usually further upstream. And once you've identified that the party is who they say they are, then you want to look at, is there a fraudster? Is that person going to behave like a fraudster and not meet their contractual obligations? So I think that's kind of what we meant by when we look at identity. Or a piece of what we meant by when we look at identity. I don't know if David or Javier has anything.
Sure.
Go ahead, Javier. Yeah.
Sure. I mean, I was going to add to Ryan's points is that so these types of fraud that he enumerated have to be addressed separately. So there really isn't a one-size-fits-all approach because you are solving for different questions, right? If you're thinking about synthetic fraud, we'll probably be looking at consistency between the identity elements because synthetic fraud, as Ryan well explained, is more of a Frankenstein identity. So we want to make sure there's consistency between the elements. On identity theft, an identity that has been well stolen is probably going to be fully internally consistent. So that question is solved more through authentication, auto wallet questions, and those type of out of channel type of measures. And then you have first party fraud. That's a separate question. The person is who they say they are. The business is who they say they are. The question is, do they want to repay or not? And that's more of a behavioral question. And that needs to be addressed more through predictive analytics based on their previous behavior.
Yeah, and I just add one piece to this. I think the definition of identity has changed and is changing continuously, particularly in digital. So when we think of identity, it's the traditional attributes of a name, an address, and a social security number, which we can do lookups and do a verification against. What we find, though, is that in a digital channel, things like the device that the individual uses and the attributes of the device, meaning what language setting does David's computer run? I work out of Phoenix, my address is in Phoenix, Arizona. What if my time zone configuration and my language setting don't align to someone that should be in Phoenix? Even though that's not part of the traditional identity attributes, we're finding these are incredibly powerful tools when it comes to solving the identity problem for both businesses and for consumers in a digital environment. So that, if you imagine that world of data starts to open up to things like, network information and the way a device is configured, and even how, as I said before, the behavioral analytics. David always uses an iPhone and he uses his touch screen a certain way and has a certain swipe gesture. Like all of those are the new attributes that Experian is using as part of our portfolio of offerings to be able to really solve the fraud problem as it pertains to identity in these checks.
Another question, a good question here. As more people and businesses moved online in the last year, is there a type of fraud that has increased? One that's more prominent?
Yeah, I'll start. Well, during the pandemic, what we saw was the stimulus funds programs were the biggest target. We actually saw a bit of a pause in certain traditional financial and transactional crimes in digital, like a little bit of a dip in e-commerce fraud, a dip in the account takeover fraud, credential theft for use in account takeover. There was an increase in some of the application fraud based on both first-party synthetic fraud and others, but we did see a bit of a pause, and we expect now, we're seeing some early trends that show that now that stimulus funds are starting to wrap up a bit, the return back to the more traditional digital fraud problems around account takeover, new account creation, and digital transactional fraud are going to be on the rise. What they would call CNP or e-commerce transactional fraud are going to be on the rise this year.
We had a question about blended data. Can you share any broad statistics about the impact of blended data on preventing fraud?
Sure. Sure. I can take that one since I covered the topic. So without revealing too much, I can say that that we have done studies for some clients, and we have found improvements on detection rates in terms of application fraud of approximately 30% when we overlaid commercial data or their consumer-centric approach. And really breaking silos helped on both metrics. It really improves on true positives. So those applications that we flagged as, hey, these are high risk, maybe you want to route for manual review, maybe you want to take additional verification metrics, tended to yield more fraud. And we also saw reduction in false negatives. Those applications that we considered of low risk actually turn into fraud a lot less frequently. So that's a stat that I can share about 30% in fraud capture metrics.
Okay, excellent. Well, I think that's all of the questions that we had here. So I think we will be leaving it there. We want to thank you. We want to thank you for panelists and for thanking you for investing your time to join us today. If you have not yet downloaded the Global Identity and Fraud Report, there's a link and a QR code here. We'll also include that in our follow-up along with a link to the recording of today's discussion. You can reach out to start a conversation with us about commercial fraud at experian.com/B2B. You'd think I'd memorize that after 8 years. Thanks, guys, for coming today. Great discussion, and look forward to our next one.
Pleasure to be here. Thanks for having us.
Have a great day, everyone.
Absolutely.